Hello everyone, this video today will cover the article I wrote regarding the strengths and weaknesses between the SMA and the EMA. So we'll get right into it here. On the chart right now I have listed the red line, as you can see, is the EMA and the purple line is the SMA. But both of them are using the input of 50 for the time frame for the number of bars it's looking back towards, so that's drawing the average price for the last 50 bars. And as you can see, even though they're both set at 50, they each have different wave fluctuations within them. And so the reason why is the primary difference between the SMA and EMA is the way they calculate the average price of an asset over a certain period. The SMA, the simple moving average, calculates the average price by adding up the prices over a set number of periods and dividing by that number. The EMA, the exponential moving average, it gives more weight to recent prices, making it more responsive to price changes in the short term. So basically it means the EMA is more sensitive to price changes than the SMA, so therefore the EMA is typically used more towards shorter time frames trading, whether you're looking for 5-minute chart, 15-minute chart, even 1-minute chart, something like that, where the SMA traditionally tends to be used more on longer term charts, such as the daily chart, the weekly chart. Right now this is just an overall S&P 500 futures charts that I'm going over it for right now. So it doesn't have to be set in stone like that, but since the EMA is more responsive to price changes, people use it on short-term charts more so than the SMA. So those are the main differences in it, and I guess kind of like the strength and weaknesses. Again, SMA is more longer term. It provides more of a balance for it, where the EMA, it responds quicker to shorter term fluctuations, so therefore it'd be better for shorter term. So there's many different trading strategies that you can use for the for trading off of moving averages. There's like the was it 3, 9, 15, and 13, something like that. So we'll touch on a couple of them, but the main one I want to go over first is the golden cross trading strategy. Now I'll put a link in the video below because I did touch on this in another video where there was another another way that I had looked up trading it but didn't. It involved using Fibonacci retracement and extensions for when you got to pull back after you got the cross. But basically all the golden cross is you use here, what we have in the chart right now is we're using the EMA right here, even though I know you're supposed to use it for shorter term, but it's easier for this on TradingView for this application right here, or trading little strategy this guy created, where he uses EMA and it has the crossover alerts for it, so it gets you in and out. It shows it real easily. So anyways, so all you can see right here, the red line is the 50 EMA, the blue line is the 200 EMA, and the golden cross strategy says all you do is when the price crosses the red to blue, and it signifies right there. I'll zoom in a little bit more. It signifies right there. You can see there's the red dot and that bar right there. That means that's where the cross happened. So you would get long right there in a perfect world. And then after that, you can get out during a set wave. You can get out. I'll show you two exits that are typically the most popular things people use when you're talking about the golden cross trading strategy. So once you're in right here, the first way you look to get out is you look for the red, the 50 EMA, to cross below the 200 EMA. So there you go right there. See it cross it right there. So you would have gotten out. There was that bar closed right there. There's a signal. You would have gotten out right there. So in this trade right here, it would have been an extremely nice trade where, say, you got in around right there, and then you got out around right there. You're looking at over 1,000 points right here on the S&P 500. It obviously doesn't get you in at the very top or bottom, because look at that. You had all the way going from back there to the bottom right there, and then the top, you had it going all the way to about right there from the top for it. So as you can see, you missed out on all that and all that, but you obviously got the meat of the run right there. So when it's in a trending market, this is a very, very strong trading strategy. But the problem with it is, which we'll touch on here in a little bit, is markets obviously aren't always trending. But anyways, so second way to get out of it, This one gets you out a little bit quicker, so it can lock in profits, but if you don't get the crossover like right there, you can miss out on something like, say, price. So the second way is when price comes in, hits the 200 EMA. So we have the crossover right here. That's what price got in on it. Price going up. We're just waiting for a pullback to the 200 EMA. So you just keep on moving your stop loss to the or exit once you get in profit to just either slightly below or on the 200 EMA, and you just keep on following it up. Just follow my mouse right there. Still good, so good, so good, up until right there. So on this one right there, if you had gotten in right here, and then there's the X right there, there's 1287. So for this trade setup, that one would have been more popular, more profitable than waiting for the EMA crossover alert right there. So those are two main ways to get out. You wait for a crossover the other way, or you wait for a retracement down to the 200 EMA. But as you can see, if you are just waiting on crosses over and over and over, and depending on what your what exit you're trying to look for, because if you look at this one right here, there you have the crossover going to the upside, signified by the red diamond. So if you're just waiting for the exit with the 200 EMA, look at that. You would have gotten stopped out for a loss right there. There's the entry. There's right there. Almost break even. If you waited for the cross, well, the cross comes all the way down over about on that bar right there. So that's definitely a loss right there. So you missed out on all that profit. So that's really kind of the big drawback right there, since it is more of a the EMA and SMA, they're both lagging indicators, and all that means is being a lagging indicator is that price confirms, and then after that you have the averages computed based through these lines right here. So that's why it gets you in later and gets you out later as well. So if you had some other way of getting out, you could have gotten in right there and say you could have gotten out right there. That would be a nice trade right there. But if you go to it, now the SP market has pretty much been in a trending market here for the past 10 years. But when you get into a range-bound market, like here you have like it seems what's be going on right here, because if you look at, say this has kind of been the lows, that's kind of been the highs right up there. I mean, it's pretty easy to see the market's been in a range-bound market here ever since at least May of 22, almost going on a year now. So you would have a crossover right here, and then you have an exit right here. Say you're going to the short side, so there's crossover right there. You're going short, and you're just looking for a crossover to the upside to get out of it. Well, there it goes right there, and there it is for a slight loss right there. So you missed out on all those gains, and even if you had waited till come back to the 200 EMA, that would have been a slight loss right there as well. And then you just keep on whipsawing back and forth. So that's the big issue with it. If there's another way that you have to work in conjunction with this as far as identifying trends and range-bound markets, then that would help this one out extremely well. But just using it by itself for it being a tool to profitability, in my opinion, won't work. You're going to have to use other trading methodologies with this one to make it work for the moving average crossover trading strategy. So those were the two main ways that the exits for the golden crossover trading strategy, and again, that seems to be, or it is the most popular one based upon moving averages. I mean, you can make them whatever you want to make them. It doesn't matter. Like right here, I mean, you can make them a 21 for the low, and this one make it like a 150. And all it does is change the settings and based on different crossovers. One guy I do like to follow, let's see here. His name is Mac, and what he, let's get rid of these things too. What he uses it on, because he day trades the S&P 500, he uses just strictly a 21 EMA right here. And the way he uses it is where he uses kind of like for support and resistance. When he's identified the trend and price is coming back to the 21 EMA, you would look to, depending on what the setup is, but just making up an example right here. Say you're looking, okay, you think the market's definitely in a down market. You're waiting for a retracement back up here, so you get in close to 21 EMA and then drive it lower down there. And so you can use it in conjunction with Fibonacci retracement levels. They hit the 1.146. It's obviously a continuation move right there for that one. and things like that. But when it's on kind of like, the south side of the 21 EMA, you're looking for the market to go down, and it's obviously above it, you're looking for it to go up. But obviously that doesn't happen every single time. So there's a lot of ways to use EMAs, but I just want to show real quickly the difference if you're looking at using the EMA or the SMA. Again, EMA is typically used on shorter term charts. SMA is typically used on longer term charts, but it doesn't really matter. You can use either one, just play around with it, find the one that works best for you, and go from there. And then the moving average crossover trading strategy, you can use that for any parameters or inputs, however you want to do it. There's a bunch of like ribbons and bands, and like, let me show you. I'll just take these off real quick, and then lastly, let me show you moving average ribbon. Like, here's one like a lot of people use right here, where obviously when price is in the trend right there, and it's kind of hard to see, so let me it doesn't look like it's going to let me do it. Yeah, well, here we go. Let me make these thicker so they're easy to see. So there you go. So you can see like there's a ribbons right here, and it's using the SMAs. So it's using simple moving average, and it's using the inputs of 20, 50, 100, and 200 day inputs for it. So in a perfect world, when all these ribbons are lined up very nicely like that, you're obviously looking at a long movement, and then when it's all going straight down right here, looking in the short right there. So many different ways to use the moving averages, but just want to go over the differences between the simple moving average and the exponential moving average. Thanks, bye.